Google's earnings report exceeded expectations across the board, with both revenue and EPS surpassing forecasts, but I won't dwell on those figures. The key takeaway from this earnings release is the continued affirmation of AI's bright future. NVIDIA, as a key supplier to the AI industry, has seen substantial revenue growth driven by large tech companies purchasing GPUs. Some might worry that these tech giants are buying so many GPUs that demand may soon be saturated, raising concerns that future AI investment could slow and trigger the so-called AI bubble to burst. However, this is unlikely. Most companies are complaining about insufficient computing power and slow AI inference speeds rather than feeling that they have too many GPUs. For instance, I recently tried the latest version of GPT, and while it delivered surprisingly impressive results, including runnable code, the inference speed was painfully slow. These large tech firms are not short-sighted, they focus on long-term investments. That's why, in a previous earnings call, Google's CEO mentioned that the risk of underinvesting in AI far outweighs the risk of overinvesting. Take, for example, DeepMind's creation of AlphaGo, an AI that plays the game of Go about 10 years ago. Did AlphaGo have immediate commercial value? No, it was essentially a toy. But it showed tech giants the potential of AI, prompting them to ramp up investments. That was the turning point when AI began to be recognized as a critical field, and companies began establishing AI research labs. Google's acquisition of DeepMind for $600 million marked the beginning of this journey. Now, after a decade, AI is finally delivering commercial value. On a related note, AlphaFold, an AI developed by DeepMind that predicts protein folding, was built on the same foundation, and it played a role in the research that led to this year's Nobel Prize. AlphaFold's potential for commercial applications, especially in biopharmaceuticals, is enormous. Google has even spun off a new company dedicated to exploring the intersection of AI and biopharma. In short, U.S. tech giants continue to invest heavily in new technologies, driving long-term growth rather than focusing on short-term gains. Looking ahead, Google's capital expenditures in AI are still surpassing expectations. Lastly, regarding my personal investment in Google, I bought the stock when it was under pressure from antitrust investigations, during which it fell. That turned out to be an opportunity, as it has now transformed from a fallen angel to a darling, and I am currently up 14%. Investing can be grueling, but it's the trust in the company's potential that helps investors weather periods of undervaluation. At a current P/E ratio of just 25, Google remains relatively undervalued among large-cap tech stocks. On a side note, AMD recently released its earnings, but its weaker-than-expected guidance led to a post-market decline. Meanwhile, U.S. JOLTS data showed job openings far above expectations, alongside stronger-than-expected consumer confidence. This sets the stage for Friday's non-farm payroll report, which could have significant implications for the market's recession narrative. I've already written quite a bit today, so I'll leave a deeper discussion of macroeconomic data and the upcoming non-farm payroll report for another time. This article is simply a record of my personal thoughts and does not constitute investment advice.